What's up everyone, it's Scotty with MoneyVest. So in this video, we are going to be talking about the volatility and the S&P 500. I'm going to break down exactly when these signals come into fruition and why there are certain times in the market environment where there are no-brainer buying opportunities, right? So that's exactly what we're going to go over. We're going to go back a lot of historical data, basically, talk about statistical probabilities of these events that are actually happening and why it makes sense to dollar cost average and to buy basically when the risk reward is at its best. So hope you guys enjoy this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. I've opened up a couple more spots if you're interested in joining our Discord and our Patreon. Link's going to be down below. We'd love to have you on board if you're thinking about joining MoneyVest community. First week of the month is the best time to join. You can access all the private channels, all the members only private videos, our stock reports, our members only private videos, trading view charts, everything's going to be included. And our engagement has never been higher. We did increase almost 40% in engagement and interaction in Discord with almost 800 plus messages per day. It was kind of hard to catch up because the server's literally been blowing up as members are coming in. So we're averaging about 800 messages per day, which is almost at 6,000 messages per week is what members are sending in the Discord. So this is, research, analysis, fundamentals, technicals, macros, trade ideas, options, everything is included. So link's going to be down below. We'd love to have you on board. So first things first, let's talk about volatility, right? So volatility is basically as related to the VIX. The correlation with SPY is negative 0.72, something that I've also mentioned in my previous videos, that this is not a perfect negative correlation, meaning that it's not like when the VIX goes up, every single time the S&P goes down. No, it's only negative 0.72. And in other words, they do move in opposite directions 72% of the times. The other 28, 25, 30% of the times, it's possible that they both move in the same direction, right? So VIX moves the opposite direction of the market, 0.72, so negative 0.72 is that correlation. And since there is a negative sign, there's not a plus sign, they move in opposite direction as opposed to the same direction. Now, many people think that the negative correlation implies a movement in the VIX is caused by the market's direction. That is only partially true. That is very, very true because it is dependent on market's expectation of that direction, not the direction itself, because volatility is very much about the implied volatility over the next 30 days. That's really what it's calculating at its more intrinsic basis. Now, this right here is since 1995, there were only 5 periods when the VIX was trading above 40%, including 2020. Now, think about that for a second, right? It's been 28, almost 30 years. 30 years, only 5 times. In those 30 years, the volatility was trading above 40%. Right? That's including 2020. And since then, we've obviously had the dot-com bubble. We've had the Great Recession, the financial crash during that time. And we've had, 2018 blow up in the market and, of course, 2020. And we also witnessed 2022, which the markets did sell off over 20%. They were in a bear market, but volatility was not that high. So, if you come over to 2022 bear market, it was very, very muted. We didn't quite get up to over 40. We actually got up to as much as 37, 38 during March 2022. May 2022, again, 35, 36. We got up to as much as 34, 35 in October of 2022. So the bottom line is that it is actually very, very rare for the VIX to be above 40. Now, I'm actually doing a research analysis myself. I'm trying to figure out what percentage of times the volatility is above 20. And that is going to be included in another video. I'm trying to kind of, check out the historical data and really understand that not only since 1995, but we're going to go back as much as we can, possibly, over 50, 70, 80 years to figure out what percentage of times the volatility is above 20. And I can tell you right now that it is going to be pretty low number. It's not going to be as low as what we're going to go over here in just a minute, but it is going to still be a low number, thereby representing how rare these events are when the VIX is at 20 and the markets are down 20% from their all-time highs. That's really what it comes down to. The bottom line is that when the S&P is down over 20% from its all-time highs and when the VIX is up to 20 levels or higher, that becomes a very rare occurrence in the market for us to start looking at deals, and the risk reward becomes very, very attractive. Now, this right here is the statistics for the magnitude of the market corrections and the highest VIX during those times. So what this basically shows us is the 1998 crisis. Volatility got up to as much as 46. So that was the high. S&P contracted over 26%. Guess what? Buying opportunity. Dot-com bubble, volatility got up to as much as 45. S&P was down 34%. buying opportunity. 2008 financial crisis, VIX was at over 81%. Now this was an anomaly because it got up to as much as 81%, which is again even more rare than 40%. S&P was down 53%. Buying opportunity. And 2011 Greek debt crisis. There was also 2018 at the time, the U.S.-China trade wars, but 48% is when we got up to that level in the VIX, negative 18%. So not quite exactly that 20% threshold, but still almost down to a bear market. And then of course we had the pandemic, 83% increase in the volatility and 34% decline in the S&P 500. So when you combine these two stats together, right, what I'm trying to say here in this video is when you combine these two, volatility at a high level, S&P at a lower level from its all-time highs, that creates very, very attractive risk-reward ratios for the market. Now, I understand that this video may not apply today, right? Because markets are not down 20% from their all-time highs and volatility is nowhere near close to 40. It's actually closer to 20. And we were at 20 last week. And that's exactly what I mentioned in the Discord when I was buying is we got up to as much as 20, 21, 20.85 levels. And since then we have been selling off. We're already down 19, 20%. And that's why there's been a general rule of thumb on the channel at least. And if you guys been watching for a long time, we've talked about this one sentence, right? When the VIX is high, it's time to buy. When the VIX is low, it's time to go. And we've kind of stuck through that mantra because it's very true. It's backed by statistics, it's backed by probabilities, and this right here is even a better chart. So what this shows us is that the larger the implied volatility, the faster it contracts, meaning the higher the volatility is, the faster it comes back down. And when volatility expands, it tends to last for roughly 2 to 3 trading cycles. And what this means is let's say the VIX contraction is from 20 to 16, which is what we're going through right now, right? It went from 20 to back down to 16 levels. Now this happened rather quickly. This happened very, very quickly, right? We just basically came down from 20 to 16 in a matter of 5 days, right? 5 to 7 days, which is very, very quick. Usually we don't see that happen. Usually the average number of trading days before a 20% contraction is 75. Right? 75 trading days, right? So we're talking, almost 4 months before that 20% contraction happens. But this time it only took us 5 to 7 days, right? Because the markets rallied back higher because we were very, very oversold from a technical perspective. Now, this right here is 30 to 24, right? 40 trading days. This right here, 40 to 32, 20 trading days. 50 to 40, right? 32 trading days, 60 to 48, 23 trading days, and then finally coming down from 70 levels down to 56. That's a 20% contraction in the VIX, 4 trading days, right? What that means is that you don't have a very, very long window of buying opportunities when the VIX is incredibly high. You've got a much longer window when the VIX is contracting from 20 to 16 versus when the VIX is contracting from 70, 80 levels down to 50s and 40s and 30s, because that happens faster and has a shorter time frame than when the VIX is contracting from 20 to 16 or 30 to 24, 40 to 32, right? Those actually take longer. So, and then if you come over to this, which is even better, since 1995, the VIX has only traded above 45%, 1.5% of the times. Think about that for a second. In 28 years, the volatility is only traded above 45, 1.5% of the times. That goes to show how rare this occurrence is for when the VIX is above 40. Now, again, I'm trying to find a very similar stat for 20. Like I said, I'm working on this research, and maybe somebody can help me in the comment section or in our community. But I'm really trying to figure out, okay, what percentage of times is the VIX trading above 20 since 1995, or even as far as back we can go? And I want to get to this number, what percentage that time is, because I can tell you it's not going to be 1.5. It's going to be closer to, I want to say like 20, 30% is my rough guess. But I want to get to that number because it's going to be a very, very good indicator from a probability standpoint, from a statistic standpoint. When that happens, what's the likelihood volatility contracts, and how often are we accustomed to seeing this from historical data? So when you combine that, right, volatility at an extreme at over 20 or 40 or 60s versus the S&P 500 returns, and this right here is also a chart that we have broken down in our previous videos, and this is going back as far as 70 years, right? You can kind of get a good understanding on why I was a little bit more enthusiastic and more sort of excited in our community to be buying stocks when the VIX was at 20 and the markets were down almost, another 8% from their recent highs, and from their all-time highs. If you come over to SPX, we were still at those lows at around 4,200, down a little bit over 12.7%. Of course, we weren't down like over 20%. I mean, 20% would have been ideal. And, during the 2022 bear market, we were down over 27%, which obviously represented even better deals. Risk rewards were fantastic during that time. But the only message that I'm trying to get across is that, look, these events, when the markets are down 20% or when the volatility is up to 20% or higher, even as high as 40 or 60, they don't come by very often. And this is a good chart to also look at how majority of those returns for the S&P are, past the 0% line, right? So in other words, S&P 500 returns after 1 year, you'll notice that majority of us are kind of sitting right over there. And most of the all-time highs obviously come, in other words, we've seen over 1,300, over almost 1,400 days where the markets were at an all-time high versus the previous high in the last 69 years. And it's very rare. You can see that the market's being down over 20%. It's only this right here. This is the section that we're dealing with when markets are down 20% in any given year, which is a very, very small sliver of the overall returns, right? So, and this is right here is the overall times when the markets are down less than 20%. And of course, this is the entire time when the markets are, positive between 0 and 40%. And there's also, again, probability markets are up like over 50, 60, 70% in any given year. So the point that I'm trying to get across, backed by statistic and historical data, is when volatility is at 40, and we're going to do our research on 20 levels as well. So there's going to be another video coming out for 20. I'll try to find more data on that. When the VIX is at 40 and S&P is below 20% from their all-time highs, that those two signals in itself become very, very good indicators to look at opportunities in the market, start dollar cost averaging, and look at risk reward ratios. Of course, there's a level of valuations. There's, a component of macros, and there's a component of what's going on around the world that needs to be analyzed and evaluated separately. But I wanted to give you guys a very quick overview of two indicators that I like to focus on very much when I'm thinking about risk and reward ratios. Now, we're not there yet. Again, I want to be very clear. Obviously, we're not volatility, just coming back from 20 levels. S&P is not down 20%. So, there's not a lot of buying opportunities. That's what really makes me a little bit more sad. And as I mentioned before, like when the markets are going down, that's when you see more enthusiasm, more deals, more opportunities, and versus when the markets are going up, what can you do? You can just trade options. You can sit on your hands and, trade a little bit, but there's not serious buying opportunities to dollar cost average. And that's the way markets work. And I want you guys to flip that consensus, right? I mean, oftentimes people buy when the markets are on the way up instead of buying on the way down. And that's really what the most important thing is, right? Buying on the way down because price is coming down, risk rewards are getting better. So I hope you guys enjoyed this video and found it helpful. Just wanted to present a little bit of that statistical probability of the markets here. As always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. And of course, link to our Discord and Patreon is going to be down below. We'll love to have you on board. As always, happy investing. I'll see you all in the next video.